This is the 2019 company pre-question Hill Limited. We've gone through quite a few of these questions so far, so I'm actually only going to focus on some of the more newer adjustments. We've seen damaged stock and we've seen patents with investment income in every question. The solutions are obviously up here on OneNote, so we'll go through them there, but I'm not going to add I'm not going to turn this into a long video. I'm going to try to make this a little bit shorter. The second part of the suspense note. So the first part is the debenture interest as it's always been. The second part, I'll just a little bit of time given to that. So we have a VAT payment of 2,500 entered onto the incorrect side of the VAT account. So they just told us that it's been put on the wrong side of the VAT account. Obviously, I have it shown out here in terms of what you need to do, but I kind of want to talk through it a little bit first. So the VAT account shown here in the trial balance is 15,000 on the credit side. So what happened was there was 2,500 entered on the incorrect side of the VAT account. So a VAT payment. This is where the terminology becomes a little bit important. I would write this down as a note, something that you need to make note of. Again, I recommend before you start any topic to leave 2 pages free for any additional notes that you may find yourself, something you need to revise over. Please take this down somewhere that you feel you will be able to access it for next year, just to help you out. A VAT payment. So the VAT account is this: debit side, credit side. Every time you pay VAT, you put it on the debit side. You put that figure on the debit side. You pay VAT. Every time that you have yet to pay VAT, it goes on the credit side. Because at the end, when it all adds up, the credit side is showing you it's everything that you haven't paid yet. So it's showing you the total liability. If you have a total liability here of 15,000, it means that you've yet to pay 15,000. The second you start paying some of this, you're going to offset from the 15,000. You're going to debit it because now you no longer owe 15,000. You've gone and you've paid, 1,000. So you put 1,000 on the debit side. So every time you make a VAT payment, you're putting it on the debit side of the VAT account. So a VAT payment of 2,500 was entered onto the incorrect side. So because we paid VAT, it means we should have reduced the amount of VAT that we owe. So it should have gone here, okay? But what happens? It was put on the it was put on the incorrect side, which means they actually put 2,500 here. Now I'm going to show you this in red, red because red doesn't count towards the total. Only reason I'm putting this here is just to show you the mistake that they would have made. Okay. 2,500 would have been put here on the credit side, and that would have contributed towards this balance of 15,000. That is a mistake. How do we get rid of the mistake? We have to debit to cancel the mistake. So not only do you need to show that the VAT payment should have gone on the debit side, you also need to cancel the incorrect mistake. Because this 2,500 was put on the incorrect side of the VAT account, you now need to cancel it, and then you put in the correct entry, which is 2,500 on the debit side because it's a VAT payment, and you're reducing the VAT that is owed. The next note I'm going to look at is the next one here, nice and quickly. I'll just look at this. We see this in the bank all the time, but this is just phrased, I suppose, as its own note here. It's just put here. A debtor who owed Hill 24 grand sent a check for 23,500 in full settlement. So if someone owes you 24,000 and they give you 23,500 in full settlement, it means that there is no more debt there. So all of the debtor needs to be wiped from the account, so we need to take the 24,000 out. We received a check, because it's a debtor who sent us money, we received a check of 23,500, which is obviously going to increase our bank. But we have a missing 500 there, and that missing 500 is going to be discount that we allowed. So we allowed a discount to a debtor. So just to show you again, as I said, I'm going to take 24,000 off debtors because they no longer owe that 24,000. I'm going to add 23,500 to the bank because the bank balance is increased by 23,500. And as we can see, the difference of 500 in as such is a missing account. The discount figure here is 12,700. That's on the credit side, which is income, which is discount received. But we are looking here at 500 discount allowed. We allowed discount to a debtor. Every time a debtor pays us off and there is a full settlement thing put in here, that means that there has been discount. We've let them off 500, so that would be discount taking away from the already existing discount received. An easier way to look through that is to show you the T account. So this is the discount account here. I'm just going to do this nice and quickly with 12 here. This is the 12.7, I'll just say. That is the discount that's already been shown, the 12,700 that we see here on the right side. And now I'm looking here at discount allowed. So it told us that we have allowed a discount. Discount allowed is a debit side because it's an expense. I'm letting the customer off of 500, so I'm going to put in 0.5 there. So essentially you're taking away 500 from the 12,700. But again, it's on the debit side because it is an expense, and it's an expense because we have allowed a discount. So whenever a debtor is paying off in full settlement, it means there's going to be a discount that's going to come into account here. And because it's the debtor that's involved, then it's discount allowed. Discount allowed is a expense. Just try to think through that. If you went to a shop and they let you off money because of a discount for a piece of clothing, you would have received a discount. It would be a form of income for you. So every time you allow a discount, it's a form of an expense. Following note we're going to look at here is the I already have a video on this, but it's the storeroom that's destroyed, and they've built another one example. A couple of different things to look at here. A storeroom which cost 20,000 and stock which cost 12,000 were destroyed by fire. A new store was built by the firm's own workers. The cost of their labour, 28,000, had been treated as a business expense, and the materials costing 62,000 were taken from the firm's stock. The insurance companies agreed to contribute 30,000 in compensation for the fire damage. No adjustments have been made in respect of the old store, the destroyed stock, or the new store. There is a lot. It's a mouthful. It's a lot to take in there. So, first thing we're looking at here is we're looking at the store itself that was destroyed. So the storeroom which cost 12,000 and stock which was 20,000 and stock which cost 12,000, which means the whole store that was destroyed cost 32,000. Okay, so something that cost 32,000 was destroyed by fire. Okay, the insurance company has agreed to give us 30,000. So this is how we'll start this one. This isn't a common adjustment to come up. There's a lot to take in there. It could take you a while if something like this, because it is kind of two notes joined together. It could take you a while in an exam to go through something like this. Just take it step by step. Break this down into individual notes. We know here there's 32,000 worth of fixed assets that was destroyed, and we're going to receive 30,000 for them. So 32,000 was the cost. This is what we're being compensated. Like the previous insurance note, I'm circling that as a current asset, and then I have my normal loss by fire 2,000. So we've seen this before. It's phrased like this now, and it completely puts everybody off, and they don't know how to tackle it. Just try to take it bit by bit. So you still see that information that you would have seen before from the other questions. Tackle it in the same manner. We'll break it down the next part. So we were looking here at the I suppose the store that was destroyed. The store itself, the storeroom, is going to be the buildings that was destroyed. So if I take my buildings, 1.25 million, I'm going to take out what was damaged, 20,000. That's gone. It's obviously no longer part of my buildings. The other thing I'm going to look at too as well is going to be purchases, because my stock, which had cost 12,000 during the year, which means we're not dealing with closing stock, we'll keep purchases. So that stock of 12,000 was destroyed. So what do? This may not be very visible to you. My purchases was 1,460,000, and I'm going to take away the damaged stock of 12,000 because that's gone. 20,000 buildings destroyed. 12,000 purchases for 12,000 stock destroyed from purchases. Now, what happened next? So this is our third part. the cost of the labor, 28,000 for the new store, had been treated as a business expense. So they had treated it like they had basically purchased something for the business, and the material for the firm's labor force, so the wages. And the second part, the materials costing 62,000 were taken from the firm's stock. So again, they're treated as a form of a business expense here. Um, the insurance company agreed, no adjustment had been made. So what we're looking at here is we're looking at the 62,000 and the 28,000 being treated as a business expense. In reality, if you build a new store, if you were to put together a new store, whatever money the wages comes to, and whatever money the stock, the materials that went into the new building, you put all that together, and that forms a part of the valuation of the building. You don't go messing around adding it to your wages, especially don't go messing around adding it to your purchases. It just goes towards your, okay, this 62,000 and this 28,000, this is investment into a building, so they contribute towards the building valuation. So this shouldn't go in here as a business expense. Can be confusing for people to sometimes understand this note, but the good thing is that the few times it has come up, they've always phrased it the same, and it's always been the same way to deal with it. So what happened? So they treated the 62,000 as if it was part of the firm's stocks. So what they've done is they've added the 62,000 that they had here for purchases, and we're going to take it away. So cancelling the goods taken for new store. So the new purchases they would have got in for this new building, they were taken as treated as the firm stock. They shouldn't have been, so we're going to cancel them. So the 62,000 is going to come out of purchases. It's got nothing to do with it. So we're going to take it out there. The second thing that we're going to look at here was the fact that the 28,000 was treated as a business expense, which means we treated that as labor. In reality, the labor account should only, or the salaries and general expenses account should only be used for uh, paying a salary towards people that are contributing towards selling something for the business. Um, so this 28,000 here was to do with an external thing we're going putting together a building. It shouldn't have come in here. So this is my previous suspense account from note 3. We didn't look at that in the video, but you can see it above. It's to do with the debenture note and the correcting the VAT note. But what I've done here is I've just added this in here. So what we're doing is we're just cancelling 28,000. Cancelling 28,000 from salaries and general expenses because it was included as a labor expense for the business, but it shouldn't have been. That could be confusing for you to look at. Let's just pretend that note 3 doesn't exist for this question, which means that these two suspense notes on the credit side and this cancelling debit note on the debit side, let's pretend they don't exist. All you'd simply do is take your salaries and general expense balance of 245,700 and you just take away the 28,000. So you just take it out. You're taking out the 28,000 because it shouldn't have gone into wages. You're taking out the 62,000 because it shouldn't have anything to do with the firm's purchases. Where should those two figures have gone? 28,000 and 62,000 should have gone into buildings, but they weren't treated as buildings. They were treated elsewhere as a business expense. That's what should have happened. So my buildings account now, I'm going to add 62,000 for goods used for the new store. I'm going to add 28,000 for wages used for the new store. So my buildings is going to finish at 1,320,000. That's a fixed asset. So again, we've gone through the first notice nice and easy. The second thing we've done here is we've taken out the 20,000 from buildings because it's destroyed. We've taken out the 12,000 for purchases because it's destroyed. And the last part of this is they're saying that the 28,000 was treated as a business expense for labor. I'm going to cancel that. Told us that the 62,000, the materials costing 62,000 were taken from the firm stocks. Now that looks confusing, the fact that they say taken from the firm stocks, but basically what it means is that they use it in their calculations for purchases. Because obviously when you purchase something, you intend on using it as a form of maybe turning it into a finished stock, or you're going to sell it on straight away. But we're not selling this stock on. This stock of materials was actually used in-house for purchasing our new for building our new storeroom. So this shouldn't have anything to do with purchases. It's a completely separate stock. So you always cancel. It always comes up like this. It's always labor and it's always materials. You always cancel it from labor, salaries. You always cancel it from purchases, and you add the two of them to buildings. So deal with the fire note as you normally would. Cancel um, the whatever has been destroyed. Take that out of the relevant accounts. And if these have been treated as a business expense, cancel them from the accounts they've been included at, add them to buildings. This note does come up now and then. It's relatively, notes like this that are generally difficult are come up in the exact same, they're phrased the exact same every time they come up, so it makes it a good bit easier. I'm not going to do this note because we've seen it quite a bit. This is the figure for advertising. Quickly go through it. It's for a 24-month campaign which began on the 1st of June 2018. So we're dealing with this question for 2018. So the advertising campaign began after 5 months of this year. So 5 months were gone and then we started this campaign, which means 7 months of the 24 months will apply to this year, and the following 17 months will apply to the next year and a bit. So therefore 17 months here is going to be current asset because we prepaid an expense, paid in advance, and the 7 months that apply to this year are selling and distribution expense because advertising is selling and distribution. So we can see that note here. Next one I want to look at here is for the paying off a creditor with a fixed asset. So creditor was owed 12,800, and what we did to pay them off was we gave them office equipment. We fully settled the debt, even though obviously there has been a difference between the valuation of the office equipment and the debt. But the office equipment had originally cost 16,000, so we know that there was depreciation involved now and everything. We need to take that out of the accounts as well. What's interesting here is there is, I think, off the top of my head, I think there was 6 notes involved in this, 6 different adjustments that were needed, but it's extremely similar to this note. Because you have a disposal, you need to find out what the depreciation was on the office equipment here. You need to find out basically what the depreciation is for the year for office equipment, the accumulated depreciation for office equipment, and you need to take out the disposal for that one. We need to change the cost of the office equipment. We also need to cancel the debt for the creditor, and we need to look at the discount. Quite a bit to go through. We'll start it as we where did I start it here, just to kind of follow the sequence I've done. So we started with creditors. So the creditors figures was 87,500. We fully paid off this 12,800. It's gone. So all of that's going to go. So you just take away 12,800. I'm not finishing the rest of this here because there's more notes on creditors to follow. Okay, so I've done that. I've taken that out of creditors. Next thing I'm going to look at here is the disposal, as we normally would. So in this case here, the office equipment had cost 16,000. So it cost 16,000. There was depreciation on it of a certain amount, and then the net book value we have here was 11,600. So it went from 16,000 down to 11,600. Therefore, there was a 4,400 euro drop off in value. That is the missing figure. It's depreciation on office equipment. Okay, so it cost 11,600. We paid off a debt of 12,800. The 1,200 here isn't going to be seen as a loss. In fact, it's going to be seen as discount that we received. So we'll deal with that in the discount account. We don't need to deal with that figure here. As we normally would, I'm going to get depreciation for the year. Before I do that, I'm going to look at the cost. So my cost for office equipment up here was 45,000. Remember, that's the net book value. This is the cost. So the cost was 45,000. I've just sold something that originally cost 16,000, so I take that out. Now I'm left with equipment of 29,000. I'm going to provide for depreciation on office equipment held on the last day of the year at 20%. So I'm going to depreciate the last day of the year's value of office equipment of 29,000 by 20%, and that gives me 5,800. That's my expense for the year. Next thing I'm going to look at, and this is just normal disposal cost, depreciation for the year, Accumulated depreciation. Well, my accumulated depreciation at the 1st is the difference between the cost and net book value figure they gave at the start, which is 10,000. I add the depreciation for the year, and I take away the disposal amount up here as we normally would. 11,400 is my accumulated depreciation. And the very last part of this is going to be the discount. So we've already changed discount above in note 4. There was €500 we took out. I'm going to add 1,200 on here because this is discount we received, which is positive, and the figure already in there was discount. Where's my discount? It was 12,700, which is on the credit side, so it's discount received. If you wanted to show it in a T account, it would be on the credit side. Note number 4 had us reducing that because we had a discount allowed of 500, and this again would be a credit entry because it's more discount received, so we'd add it of 1,200. Give us a final discount figure of 13,400, and that is an income. It's an operating income figure that we put into the profit and loss. So again, this note, there is a good bit to it, but it's a normal disposal cost depreciation for the year, accumulated depreciation note. The only difference is we also have to cancel the creditors, and we need to look at the difference here from this being a discount received in this case rather than a loss on the value of a disposal, because we would have paid off somebody 12,800 by giving them something worth 11,600, so obviously we had received a discount on it rather than looking at it as a loss. Last note I'm going to look at here is the record for goods in transit. So no record has been made for goods in transit on the last day of the year. Invoice for these goods has been received, so we've received an invoice for 18,450 including VAT. You can see this down here again. Including VAT at 23%. So 18,450 is going to be equal to 123% because it includes VAT. So I'm obviously going to need to calculate the 100% as well. So 100% works out at 15,000. A couple of things I need to change. I have my closing stock. So what's after happening here is that I have basically purchased. The reason I know I've purchased is because I've received an invoice, which means I've received a bill for goods in transit. So this is an item that I have purchased at the end of the year, and it hasn't been included in the accounts. Therefore, it was not in the storeroom because it was goods in transit. It was not in the storeroom at the 31st of the 12th, so it was not included in my closing stock valuation. So to do that quickly, first, my closing stock, I need to add this in at its cost value, which is 15,000. So I'm going to add 15,000. Oh, we've done this previously. I did this up in, yeah. So this is my purchases figure here that I'm adding my creditors. Oh, this is my closing stock, sorry. So my closing stock, this was the original closing stock from note 1. What I have here is from this note here, for note number 9, I have 15,000 here that I'm going to increase my closing stock with because I purchased goods at the end of the year. So if I purchase goods at the end of the year, I'm going to have more stock. So I need to add this in here. What else would happen? Well, I've also increased my purchases. So I'm going to add to my purchases. I've increased my purchases by the cost price of 15,000. Don't include the VAT here again. It's just cost price here for goods in transit and cost price for our purchases. The cost price being 100% and not including the full cost plus VAT. Okay, so I purchased something. I purchased it on credit because it is an invoice and I'm receiving the bill, which means I haven't paid it yet. So I need to look at my creditors account. So my creditors account is down here. So my creditors account is what I'm going to have to give to my creditors. I'm going to have to pay the creditors for the cost plus VAT. So I need to pay them the VAT as well. So the creditors is going to include the full 123%. It's going to include the 18,450. So that's the creditors for this note. I'm adding 18,450. And the final thing we have down here as well is the VAT. So we have the VAT here of 23%, and that being the 18,450 that we see up here, being 122%, and the 100% being the 15,000. So therefore the 23% VAT is going to be the difference. It's the 3,450. And whenever we're dealing with purchases, the VAT is going to be on the debit side. As we won't owe this money, we'll have paid to the creditor. We won't owe this money to the government at the end of the year for VAT. This will offset this from all the money that we'll owe the government from sales for VAT. So purchases for VAT will go at the debit side of the VAT account. So that is that note. I'm going to quickly look at the last one again, just because we've only really seen this in companies. We've only seen this a couple of times. Managing director should be paid commission of 2.5% on all sales in excess of 1.25 million, and a further 4% in excess of all sales over 1.5 million. So we know that everything from 1,250,000 to 1,500,000 will get 2.5%, and when we know everything above that will get a further 4%, which means it's 2.5% plus 4%, obviously being 6.5%. So I'm going to go down to my sales figure here, which I have given from the question. We don't seem to have adjusted it, so it's 1,880,000 is my sales. I note that every bit of sales above 1,250,000 up to about 1,500,000, so that 250,000 I know gets commission at 2.5%. So you could do this two ways. You could do the 250,000 multiplied by 2.5%, and then you could do the remaining 380,000, which is everything above 1.5 million. You could do the 380,000 multiplied by 6.5%. Or you could treat everything above 2.5 or 1.25 million, which would be 630,000. You could treat all of that as 2.5%, and then knowing that everything above here we get an additional 4%. So 380,000 by 4%, which is what I had done at the time when I had done this question. But the other way is actually the way I was going to introduce it right now if I was to write it down. So either way would be perfectly just way for figuring out the answer. So again, probably the easiest way to look at it is everything from 1.25 million to 1.5 million. So that's 250,000 multiplied by 2.5%, and then everything above here, which works out at 380,000 multiplied by 6.5%, because you had an additional further 4%, a further 4% in excess of sales. So 4% plus 2.5% is 6.5% commission above 1.5 million. Whichever way you do it, you end up with a final answer down here of 30,950. This is a selling and distribution and expense, and also it's money that we have yet to pay, so it's current liability.